Hello and welcome back to Global Value. In today's video, we are performing a fundamental stock analysis of International Business Machines Corporation, better known as IBM, ticker symbol IBM. We're looking at IBM today as a subscriber request. IBM is a Dividend Aristocrat. They're both a member of the S&P 500, and in their specific case, they've increased their annual dividend payments for each of the past 26 years. Dividend Aristocrats have done that for each of the past 25 years. So this is IBM's second year of Dividend Aristocrat status. Currently, IBM is also paying out a very lofty dividend yield of nearly 4.9%. Right now, IBM is trading for $136.96 per share. Over the past year, their stock price is up 7.5%, which is in pretty sharp contrast to the overall market. Over 5 years, however, IBM's stock price is down 10%. Over 10 years, their stock price is down 28%. And going back prior to the global financial crisis, over the past 18 years, IBM's stock price has only compounded at a rate of about 2% annually. Keep in mind that this is not including the dividends that they're paying out. So their actual return to shareholders over this time would be above this, but still trailing what the S&P 500 has done over this time. IBM is trading about $7 off their 52-week high. They're up more than $20 from their 52-week low. About 3% of their shares outstanding are currently sold short, and they're a very large business. They have a $124 billion market cap. For additional background about the company, IBM looks to be a part of every aspect of an enterprise's IT needs. The company primarily sells software, IT services, consulting, and hardware. IBM operates in 175 countries and employs approximately 350,000 people. The company has a robust roster of 80,000 business partners to service 5,200 clients, which includes more than 95% of all Fortune 500 companies. While IBM is a business-to-business company, IBM's outward impact is substantial. For example, IBM manages 90% of all credit card transactions globally and is responsible for 50% of all wireless connections in the world. The company was formerly known as Computing Tabulating Recording Co., and International Business Machines Corporation was incorporated in 1911 and is headquartered in Armonk, New York. So for our fundamental analysis today, we are performing the Select 6 analysis, taking a checklist approach of 6 standard financial metrics to come to a holistic and beginning understanding of IBM based off of their business fundamentals. So this analysis is still a work in progress and it's an opportunity to learn in public. It will continue to improve and get better over time. So with that said, let's get right into today's analysis. Starting things off with metric number 1, we want their average return on capital over their last 5 years to be above 14%. So there are a couple of reasons for this. The first is that the average publicly listed business earns about a 7% return on capital. And the second is that over the long run, over the course of decades, a stock is going to return approximately what its underlying business returns. And these business returns are going to be captured here by return on capital. So by asking for 14% returns on capital on average or better, we can potentially build in some margin of safety for ourselves based off of the overall quality of their business being about twice as good as that of an average company. Since 2018, IBM has been earning about average returns on capital. Over their last 12 months, their returns are slightly better than where they've been at over these last 3 years, with about 9.5% returns on capital. However, when we average this out, over the last 5 years, IBM is only producing about 12% returns on capital. So while that is better than average, that's slightly below that 14% mark we were looking for. And so this is an X to start things off on metric number 1. It looks like they were doing better in this regard in 2017 and 2018. But again, since 2018, the business's returns on capital have just been about average or just very slightly above average at best. Next up for metric number 2, here we're taking a high-level overview of the cash coming into their business. We want their revenues, earnings, and free cash flows to have grown over the last 5 years. This metric is all or nothing in nature. Either all 3 of these are going to be up for a check, or if even one of them is down, this entire metric will be an X. So over this time, IBM has seen a pretty substantial revenue decline. Their business has declined over the years. At the same time, however, their earnings are almost exactly flat. They're just down a little bit over the last 5 years. But the more important thing to note here is that their free cash flows are down by quite a bit as well. So over the past 5 years, IBM's business has actually shrank. All 3 of their revenues, earnings, and free cash flows have actually declined over this time. And so this is our second X in a row on metric number 2. We're starting off 0 for 2 on IBM. Next up for metric number 3, here we're taking the perspective of an individual shareholder in the business by looking for earnings per share growth over the last 5 years. So as we learned in the last metric, their earnings were down over this time. At the same time that they saw a decline in their earnings, IBM has bought back about 3% of their shares outstanding over the last 5 years. However, even with these share buybacks to offset some of that earnings decline, their earnings have still gone down at a rate that's faster than those buybacks. and so their earnings per share are down as well. So this is another X here on metric number 3, still looking for our first check on IBM. Metric number 4 is going to be very similar. Here we're looking for free cash flow per share growth over 5 years. Again, very similar situation to our last metric. Their free cash flows have declined by quite a bit over this time, and their decline in free cash flows has been greater than the rate of their buybacks. So over the last 5 years, including their last 12 months, to bring the company's financials up to currently, their free cash flows per share are down almost half over this time. So this is yet another X here on metric number 4. We are 0 for 4 for our first 4 metrics for IBM. Metric number 5, here we're evaluating how IBM is utilizing leverage in their business. So we don't want to be investing in overly levered businesses because during economic downturns, it's overly levered businesses that are at the greatest risk of poor financial outcomes. So we want their net debt, which is long and short-term liabilities minus cash and short-term investments, to be below the amount of free cash flow that IBM has produced over the past 5 years. So IBM ended last year with $48 billion in net debt. Since then, they've managed to decrease this. So currently, IBM has $44 billion in net debt. And at the same time, over the last 5 years, IBM has produced more than $64 billion of free cash flow. This means that IBM, relative to their free cash flows, is employing a reasonable amount of leverage in their business. And so this is potentially indicative that IBM is not overly levered here. However, keep in mind that over their last 12 months, their free cash flows have come down quite a bit from where they've been at historically. So you would really want to understand the company's free cash flows in more depth to really get a better sense of this metric overall and IBM's financial position going forward into the future. Nevertheless, this is going to be our first check here coming in all the way near the end on metric number 5. Then our 6th and final metric, the big metric of them all, we want their average free cash flows to their total enterprise value to give us a yield that's above 5%. If this is the case, this will give us a slight risk premium to the rate of the 10-year treasury and give us another reason to potentially be interested in IBM. So we're using their total enterprise value here rather than their market cap because total enterprise value is going to give us a picture of the economic reality of the business that's going to be more similar to as if IBM were a private company. That'll help us get a better sense of the economic reality of the company by taking into account both their market cap and their net debt position. So currently, IBM has a $168 billion total enterprise value, and we learned that over the last 5 years, IBM has produced $64 billion in free cash flow, which means that in an average year, IBM is producing about $12.8 billion in free cash flow. So when we divide their average free cash flows of $12.8 billion a year by their $168 billion total enterprise value, that gives us an average free cash flow to enterprise value yield of approximately 7.5%. So on an average historical basis, IBM's cash flows relative to their total enterprise value actually do look attractive compared to the yield of the 10-year treasury right now. So this means that IBM could potentially be a business worth considering. This is another check here coming in at the end on metric number 6. Worth being aware of as well, however, is that as mentioned, IBM's free cash flows over their last 12 months are significantly down from where they've been historically. Over their last 12 months, IBM has produced $7.6 billion of free cash flow. So to get a current free cash flow to enterprise value yield for the company, when we divide their $7.6 billion of their last 12 months of free cash flow by their $168 billion total enterprise value, that gives us a 4.5% current free cash flow to enterprise value yield. So even though that's just slightly above where the 10-year treasury is at right now, that is below the 5% we're typically looking for. And so as often is the case for businesses that have differences on these average versus current numbers, the economic reality of the business probably lies somewhere between this 4.5% yield to this 7.5% yield of where they've been historically. Then here we're looking at IBM's dividend profile. As mentioned, IBM is a dividend aristocrat. They've consecutively increased their dividend payments for each of the past 26 years, and currently they're paying out a 4.9% dividend yield. So IBM has steadily but incrementally increased their dividends per share over this time. So that's both a result of their increased dividend payouts and their buybacks. At the same time, in all 5 of these financial years, IBM has been able to support their dividends with plenty of free cash flows per share. Over their last 12 months, their dividend payments are a little bit more stretched. However, they're still managing to support their dividends with their cash flows they're bringing in. This is important that IBM is able to support their dividends with their cash flows, because people can make mistakes all the time by blindly chasing dividend yield. And so to better understand the health and potential sustainability of a company's dividends going forward, you want to stop and look at the fundamentals of a business and make sure that those dividends are well supported by their cash flows and that the business is not overly levered, potentially meaning that the company would have to use their cash flows somewhere else. Cash flow is really the lifeblood of any business, and a business can use their cash flows to pay dividends, buy back shares, pay down debt, make acquisitions, or reinvest back into their business. Ultimately, a business's abilities to produce free cash flows now and until Judgment Day, discounted back by some reasonable interest rate, is what that business is going to be valued at. So free cash flow and a business's abilities to support their dividends with their free cash flows are very important, and it's a potentially good sign for shareholders, especially going forward, that this is the case for IBM. Their abilities to increase their dividends potentially going forward into the future are really going to depend on how they're able to either stabilize or, better yet, increase their cash flows going forward. Then finally, here we're using a discounted cash flow model to come to a potential fair value for IBM. So starting with an average of their free cash flows, which again, this average of their free cash flows is significantly above where their current free cash flows are at. This is assuming that IBM is going to be able to get back to their historical baselines. Then using growth assumptions based off of IBM's abilities to grow their average free cash flows historically over the past 30 years, dating all the way back to 1990, where over the next 10 years, the company has a growth stage where they grow their average free cash flows at a rate of 4% annually. And then over the 10 years out after that, so projecting 20 years out into the future in total, where the company's free cash flows are totally stagnant and they don't grow, but they don't decline. If we were looking for a 10% rate of return from IBM, then it looks like a potential fair value for the business is right around $133.50 per share. So that's only about $3 below where the company's current stock price is at right now. Keep in mind that we're not adding in their tangible book value because that's going to be significantly skewed by IBM's buybacks over the years, which is a byproduct of how accounting is done for share buybacks. Also, there are a couple of really important caveats. One, again, this is based off of their average free cash flows, which is not where their current free cash flows are at right now. So this is assuming that the company is able to get back to its baseline average. And then two, this is just used as a baseline projected estimate going forward into the future for IBM, which is based off these historical growth assumptions that you need to do your own homework on. So you need to verify for yourself whether or not these are going to be both accurate and applicable potentially for IBM going forward into the future. Then finally, this 10% rate of return going forward would be including the company's dividends. IBM is currently paying out a 4.9% dividend yield, so that would be about half of this future return coming from their dividends alone. So please be mindful that this type of analysis is not financial advice, it's not a buy or sell recommendation of any security, and before considering any potential investment decision, please consult with the properly licensed and registered financial and legal professionals. So in summary, IBM only checks the box on 2 out of our 6 metrics. They had a very rough start, where even though the company earns above average returns on capital, they were below that 14% mark we typically look for. Then the company's business has declined over the past 5 years. They've experienced declines in their revenues, earnings, and their free cash flows. And even though they bought back about 3% of their shares outstanding over this time, that wasn't enough to offset some of these declines, so their per share numbers were down as well. However, things look brighter for IBM when we looked at their average historical cash flows. Based off of those historical cash flows over the past 5 years, it looks like the company's using an appropriate amount of leverage in their business. That could potentially get a little bit dicier given the fact that they've seen a major decline relative to where they've been historically with their current free cash flows over their last 12 months. But on an average free cash flow basis compared to their current total enterprise value, the company does look potentially attractive and looks like it would potentially give a slight risk premium to the rate of the 10-year treasury. However, that doesn't seem to be the case for their current free cash flow to their enterprise value yield, as that rate is just about in line with that of the 10-year treasury. Also looking at their dividend profile, in all 5 of these financial years, IBM was able to easily support their dividends with their cash flows. However, while they're still able to support their dividends with their cash flows over their last 12 months, things do look more strained for the business potentially going forward, unless they're able to continue growing those cash flows into the future. Then finally, performing a discounted cash flow analysis of IBM based off of historical assumptions for IBM's abilities to grow their free cash flows dating back all the way to 1990. So using their average free cash flows and then projecting those out into the future using those growth assumptions, which you need to do your own homework on to determine whether or not those are going to be potentially applicable going forward into the future. That IBM at today's valuations looks like it is about appropriately priced for a potential 10% rate of return going forward. Keep in mind that about half of this would be included by their dividend payouts, and that this 10% rate of return would be a few percentage points of compounded annual return above what IBM has been able to do over the past 18 years or so. So it might be a little overly ambitious for the company going forward. Again, it's worth reiterating that this type of analysis is not financial advice, it's not a buy or sell recommendation of any security, And before considering any potential investment decision, please consult with the properly licensed and registered financial and legal professionals. Instead, this analysis serves as a beginning and holistic understanding of IBM to help you determine whether it's worth your time and energy to dig in and learn more about the company going forward. So one resource that will definitely help you stay up to speed with what's going on in the market and will help you learn more about IBM is Seeking Alpha. Checking out Seeking Alpha will directly support the channel as I'm part of their affiliate program. So most of you probably know Seeking Alpha as a source of community-written articles on different stocks, but over the past little while, they've actually become a lot more than that with their new offering, which is Seeking Alpha Premium. Premium has a number of different features where you can track buy, hold, and sell ratings on your favorite stocks. These ratings are from the Seeking Alpha community, Wall Street analysts, and Seeking Alpha's own proprietary algorithm. You can also add your own margin of safety targets and be alerted when your favorite stocks hit that level. You can see earnings call transcripts, investor presentations, SEC filings, and press releases all in one place. You can get 10 years of financial data on any stock to help you with your models. You can get unlimited access to Seeking Alpha articles, and you can tailor your reading experience based on the type of investor you are. You can also import your portfolio into your Seeking Alpha dashboard to make researching easier. And if that didn't convince you, the best thing is that an annual plan is only $99 through my referral link down in the description below. Normally, premium is $239, but they're currently running a general offer for $119. But if you use my referral link, it's $99. So with that said, check it out if you're interested. Seeking Alpha is just one potential resource you can use to learn more about the business. You can also read through the company's filings on the SEC website. Ultimately, as a value investor, you're trying to conduct your research as if you're going to own 100% of the business going forward, and you can truly understand the underlying essence of the business and know what's important and what's not important for IBM as a business. So ultimately, through this deeper research, you'll learn more about both the qualitative and quantitative aspects of IBM, and you'll be able to determine for yourself what a potentially appropriate intrinsic value for the company will be. Then you can compare that to other potential investment opportunities. So with that said, that's it for today's fundamental stock analysis of International Business Machines Corporation, ticker symbol IBM. So again, IBM was both a subscriber request and they're a Dividend Aristocrat. So I'm happy to make an analysis of the business today. If you enjoyed today's video, please be sure to like the video, subscribe to the channel for more stock analysis videos, and comment down below what business you want me to take a look at next time. Thanks for learning about IBM with me, and have a great day.